Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hello and welcome back to the Investing Podcast. My name is Ben Nye. Andrew was stuck in traffic this morning. Actually, it was just coming in when we were walking over to the studio, which is cold today. Garrett's in his jacket, off camera, I'm in my jacket, so bear with my jacket. Also, I have a little less rind on me now because it is no longer No Shave November, so I did take some off the top there. So it's a little bit shorter now. But check out our previous podcast. We did a good one the other day on Microsoft. At least I thought it was good. You can disagree. But we also discussed, some of the accounting issues that they have, and I thought we brought to light a few things that people don't really talk about, especially if they're bogged down in the kind of the number world of the analysis part of Microsoft. So take a look at that. But today I kind of wanted to touch on what's been happening in the high yield bond surrogate space. So for a long time, what happened when yields kept going lower and lower, people said, well, I'm not going to lock my money up by lending to the U.S. government for 10 years at 2%. Instead, I'm going to buy Campbell Soup, or I'm going to buy Philip Morris, or I'm going to buy Unilever, or Budweiser, or Verizon. So they're buying these stocks, pushing those prices higher and those dividend yields lower. But what happened after yields bottomed right after Brexit in July, what you saw was that a lot of these stocks got crushed. So today I kind of wanted to talk about what some of these stocks are, if there's opportunities there now after the bond rout that we've had, and finally whether or not this bond rout is overdone. Because if the bond yields continue to trend upward, then all of a sudden you're thinking, maybe these staple stocks will continue to fall. So quickly, let's look at a few of the stocks that have been crushed. So the first one, which really takes the cake, is Budweiser. Anheuser-Busch. A lot of stuff going on with this space. There's some mergers going on. So you got to bear that in mind. They also have a large amount of debt they'll have to refinance. They don't want to do that at high rates, obviously. So they would like rates to come down, not only from a stock valuation perspective, but also from the perspective of wanting to borrow at a fixed rate at a lower rate. So right now they're at a floating rate. They want to lock that in for a longer term at a lower rate. So Budweiser down 30%. Now, no matter what's going on with the merger, you can't come and tell me that Budweiser is, Anheuser-Busch is 30% less valuable today than it was 3 or 4 months ago, just as a value of the enterprise. And if you have a normalized free cash flow model, or your model normalizes for interest rates, that should not fluctuate that much. You need to adjust for those interest rate fluctuations in your model. So Budweiser down, Anheuser-Busch down 30%. Unilever, a stock that I've been pretty bullish on, has been down 20%. Unilever has some operational issues. Their revenue growth is not what people want to see. They did have their analyst day the other day, and they raised their forecast for the operating margin expansion from 20 to 40 basis points to 40 to 80 basis points. Now, 20 to 40 basis point increase may not sound like a great deal, but for a company like Unilever, who really tries to milk every piece of earnings from a given number of revenue, that is actually a pretty big deal for them. And it shows that their operations are not falling off a cliff. So Unilever down 20%. Verizon down 10%. It was down a lot more. It was down 20% at one point. It's come back now. But again, you have a company here which has the premier telecom network in the United States. And the thing with Verizon is that once you own the spectrum, in contrast to a lot of other countries where the spectrum then comes up for auction in a couple decades later, that's not the case in the United States. Verizon has the spectrum, And it actually doesn't even depreciate the spectrum on its cash flow statement or its income statement, because once they have the spectrum, they have it in. They can renew it for a nominal cost when it comes up for renewal. So Verizon down 10%, again, just getting hit with the decline in interest rates. And then you have Novartis. So healthcare's been slammed for a number of reasons, not least of which is the pricing and the aspect of price collusion, especially in the generic space. You've seen Teva get hit by that, Mylan get hit by that, a few other companies get hit. Novartis was not implicated in that lawsuit, despite having a large generic business in the form of Sandoz. Novartis was not implicated in that. Their stock is down 18%. So you say, well, if that's just getting hit with healthcare, maybe that's 10% of it. And I think probably another 10% is from the rising interest rates, because Novartis does carry a high dividend yield. So you're seeing, although everyone is talking about the S&P 500 on all-time highs, you're seeing a lot of discounts in the market and dislocations in the market because of the rise in interest rates, and I think that creates an opportunity. So let's look at quickly how interest rates have gotten. 10-year hit a low of 1.4% and is now 2.4%. That's a 100 basis point increase. When you look at the convexity, that means that's a dramatic decrease in the value when you discount that back. It's even a bigger discounted value when you look at the 30-year bond, which has gone from 2.1% to 3.1%. Again, 100 basis point increase in the 30-year. So a parallel shift of 100 basis points. That is an interest rate shock, and that also explains why financials are up 20, 30, 40, in the case of Citizens Financial Group, 50%, because they're so levered to an interest rate move higher. You're going to see those earnings expand for some of the financial companies if interest rates remain where they are. And I think a lot of this has accelerated in the past month since Trump won the election. But prior to that, what you were seeing actually drive, and wasn't really fully appreciated by the market, was that European bond yields, which were accelerating to the upside, were kind of driving the United States bond yield. So I'm talking about the gilt, which is the UK 10-year bond. That rose from 50 basis points to 1.5%. That's a meaningful move, paying next to nothing, and now, at least you're somewhat almost in line with inflation. German 10-year, negative 25 basis points. Garrett, would you pay the German government to take your money?
No.
So that's,
no, I would not.
And now it's 33 basis points on the plus side. So again, a 50 basis point rise for the German 10-year bond. So Garrett was paying the money, and now he's finally getting paid by the government, by the German government. So these are the moves that we've seen in the bonds, and that's what's predicated the decline in a lot of these staple stocks, these companies that have been around forever and are going to continue to be around forever, who continue to pay these large dividends. So although you've seen some valuations at the top end in the energy space and in the tech space really rise, and especially in the consumer discretionary space rise, you're seeing a lot of the more boring names fall. And we actually saw this in the 2000 tech bubble, when you had a lot of the NASDAQ bubble really pop, but there were a lot of those forgotten companies kind of at the bottom who would own 3M in 1999? If you own 3M, you're an idiot, because Joe down the street was buying pets.com and he was making 100% every day. And that's just how it was. And once again, you're seeing these companies like Unilever, like Verizon, like Anheuser-Busch kind of get left for dead. So there could be an opportunity there. But as we talked about in the beginning, if you want to purchase one of those stocks, you have to make sure that you're comfortable with the duration. Duration is a fancy word for interest rate risk. And if interest rates continue to rise, and especially if they accelerate, to the upside. Where you're going to get is a continued decline in valuations for those companies. So when you look at your portfolio as a whole, to the extent that you own less fixed income that you want, you may want to pick up some of these stocks. To the extent that you own more fixed income than you would like, you may want to continue to be patient, wait for a sentiment to get even more bearish on bonds until you come into some of these names. This has been the episode of the Investing Podcast. Tweet at us at Tusk Media LLC. You can tweet at me, Benjamin Nye, on Twitter. And catch us next time. Hopefully we'll continue to have some good content. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.